Welcome to Exchange Traded Fridays, brought to you by ETF.com. I am your host, Paul Curcio, managing editor of ETF.com. Joining me today is ETF.com's fantastic team of writers and editors. First off, we have senior ETF analyst Sumit Roy. We also have senior content editor Kent Thune and financial reporter DJ Shaw. Welcome, everybody. We've got a lot to cover, as always. It's been a busy week, so let's dive right in. So it looked to be a quiet week with the markets being closed on Monday for Memorial Day, the holiday. But as you know, from the first Trump administration, the quiet doesn't always last long. On Wednesday, late Wednesday, after the market closed, a federal trade court upended the president's global tariff strategy. And I won't get into the details here. But the upshot for investors is this. Markets immediately rallied on the news. Now, what that tells me is that investors are not 100% on board with the tariffs and the economic uncertainty that they bring. It even has a name now. They're calling it the taco trade, which represents, it's an anagram for a taco. Trump always chickens out, which traders on Wall Street started using when they started to notice this back and forth trend of him announcing tariffs and pulling back the tariffs. Markets go up, markets go down. So we've been in this buy the dip, sell the rip loop for a few months now. So here's what I'm going to put out to you guys. For an ETF investor, how do you deal with this? What's the best strategy to navigate the volatility of the taco trade? And what ETFs do you add to your portfolio to profit from it? Or what ETFs do you use to stay above the chaos? Let's start with Sumit.
Yeah, I mean, it's a good question. I think it ultimately depends on what kind of investor you are. I think for the regular investor who's investing for retirement or has a long-term goal, obviously stay the course. Don't look at the headlines and trade in and out based on that. So if that is your goal, something long-term, then you want to stick with something like a VOO. But on the other hand, these headlines are offering opportunities for traders, people who like the volatility, who want to go in and out. Obviously, everyone's trading strategy is different, but one that I continue to go back to is the QQQ, right? It's heavy in big tech. Big tech continues to work. They were hammered during the April sell-off in the markets, but they've come roaring back. We just got NVIDIA earnings, and believe it or not, it's close to all-time highs again. Last I checked in the 140s. This actually bottomed out in the 80s back in April. So we're talking huge, huge gain. And QQQ obviously has big weighting in NVIDIA, along with Microsoft, Meta, and all of these big tech winners who are riding the AI wave. So I think it's simple to just use QQQ for trading purposes. I mean, we can get fancy with all these other ETFs like SMH, SOX, whatever. There's so many out there. But I think QQQ is just such a stalwart. It's delivered time and time again. So I think if you're going to trade swings, this is an obvious one to look at.
Yeah, I'm glad you mentioned SOX because the semiconductor index and the ETF space often have been in our news lately for sure. So that's always something that not everybody looks at, except for the most ardent and hardened
Yeah,
traders.
exactly. And like we have VU, right? It's going to give you beta exposure, but if you want more bang for your buck as you're trying to time these swings, QQQ is going to give you a little more. If you want even more, you could go to something like SMH or SOX. So those are options out there. It just depends on what kind of risk reward you're looking for.
For sure. And risk reward is in everybody's mind right now because there's lots of risk, but there's also possibly plenty of reward. Maybe some
Absolutely.
heartbreak too. You never know.
Well said.
DJ, what say you, sir? What would you put out there?
Well, I'm going to take a little bit of a different view than to me because I thought about this, if you're looking at the headlines, what ETF stood out, what ETF has done well, and what's getting some hype. And my choice for your question is EUAD. the iShares European Defense ETF. It's up about 68% this year and 30% over the past 3 months. So if you're looking for a way to avoid volatility, this one has just been on a tear so far this year. I wouldn't say this one is directly correlated to what's going on with trade right now, but it has returned to the headlines as, people look at Trump's past comments about NATO or kind of see this, new questioning US support for allies that, have pushed European countries to really take defense into their own hands. So this has helped drive some strong interest in the companies that are held by this ETF.
So you're looking for the merry-go-round as opposed to the roller coaster. You're not you don't want to you don't want to get away from the thrills and the chills so much and look for a steady investment that's been rising steadily with some of the global context, global economic context.
Well, this one has been consistently doing well so far this year. So yeah.
All right, I could go for that. So Kent, what do you do? What do you go for? Do you take the roller coaster or you get on the merry-go-round?
Maybe a little bit of both. I mean, I'm at the core, I'm a buy and hold investor, and the same with my investment practice for clients. I mean, it doesn't make sense to really time the market in an absolute sense. I mean, if you look at history, some of the biggest up days or gains in the market are immediately following the losses. For example, on April 8th, when the tariff pauses were put into place, the market was right at near a 20% correction, which is a very standard entry point for market timers, if you will. So there's a lot of people ready to buy at that point. But also, so the market was up 7% that day, roughly. And so if you're out of the market because you're timing it, then you miss the 7% gain. Now, I'm not saying I'm a genius, but I was ready to buy for some of my money and my clients' money on a 20% decline. I usually go about 19% because when the algos kick in at 20, you already missed that big rip higher. So I was buying on that day. Now, for that strategy, I'm not recommending this for everyone, but if you're trying to trade Trump's behavior, and you mentioned his first term, I like to be politically agnostic. I mean, just who cares about the political ideology? Are they tradable? Trump is very tradable. He is a president that comes up with these ideas and puts them out there, like them or not, but it's going to make the markets move up and down.
But is he investable? Right? He's tradable. But
right.
if you're a buy and hold investor, right now all you're doing is sitting back and saying, I got to write this out because it's up, it's down, it's up, it's down. Maybe dollar cost average on the dips.
Right. I mean, some people, there's a term the traders like to use, buy the dip, sell the rip. That has been working, especially on an extreme dip. So when you see everyone panicking and the media is saying this is terrible, that's when you're buying. Now, arguably, say now the market's up a little bit, and it even came up a little bit more with the news of the trading international trade court or whatever was saying, hey, this is unconstitutional.
Well, they didn't exactly say that, but yeah, something along those lines.
Okay,
but
yeah,
I don't want to get into the details of that, but yeah, they basically struck down his tariff strategy.
I haven't read it yet, to tell you the truth, but I'm looking at the markets, and so they were up a little bit with futures and up a little bit in the morning after the news hit, which is Thursday morning. So that's not a bad time to sell. And so what I would say to answer your question, back to the beginning, a low cost S&P 500 index fund. I like IDD personally. Buy that on a dip, and then when you're selling, maybe put that back into SGov and at least earn some interest until you're ready to buy the next dip. Otherwise, just stay buy and hold and dollar cost average in.
Wash, rinse, repeat.
Yeah, man. This is not a bad environment for long-term investors or traders. But to answer your question, Trump is very tradable, questionable as to whether he's investable.
Yeah, I mean, I think that's the big thing for the type of investor that you are, it poses a lot of challenges to be in this market, and everybody has to really dig down deep and look at who they are and what they really want out of it, I think. So Trump holds a mirror to all investors. It's an interesting time that we live in, isn't it? So also, we want to talk about some other stuff. Earlier this week, Kent, you had an opportunity to chat with a very special guest about buffer ETFs. So why don't we have a listen to that right now?
Okay, today we're joined by Graham Day, Chief Investment Officer at Innovator ETFs, who will share his knowledge about the hugely popular buffer ETF space, including the market environment for buffer ETFs now, as well as the type of investors that can benefit from these funds and some of Innovator's recent launches in the space. Graham, thank you so much for joining the Exchange Traded Fridays podcast.
Ken, it's great to be here, and I'm looking forward to our conversation.
Awesome, me too. So let's jump in. What are your thoughts on the general buffer market at the moment? You know, how are today's tariffs and volatility impacting the industry, for example, either via performance or client adoption?
Well, Ken, I think that 2025 has shown that risk management is still of the utmost importance for advisors. The uncertainty that the tariffs have really unleashed on the markets, where nobody really has a playbook for this. There is no playbook for this type of market. And so we've had quite the year where the market dropped 18, 19, 20%, and now it's rebounded, but we're finding ourselves right back where we started the year. And so we have a lot of clients saying, where do we go from here? And so I think this is one of the reasons why our buffer ETFs have become so valuable, is because those clients that were invested in buffer ETFs at the beginning of the year, they maybe took on a little bit of the downside. They were buffered from a lot of the downside. The market's recovered. They're right back where they started. And so just a simple example of 15% buffer ETF in 2025. If you can imagine the downdraft the market had, it's recovered. Well, so has our 15% buffer ETF. And now for the rest of the year, an investor in that product still has upside, a 12 or 13% upside to the market, and now they still have a 15% buffer on the downside. And so that is the type of certainty that a lot of investors, a lot of advisors are looking for. And we think that this adoption of buffer ETFs is only going to grow, because when it comes to risk management, advisors, they want certainty. Their clients want certainty. They don't want to hope that their risk management is going to work.
Right. Yeah. I mean, you mentioned the word certainty a couple of times. It seems like the only thing that is certain now really is uncertainty, and which circles right back to how are you going to protect downside? I mean, I don't think anyone's making large bets that the the economy and capital markets are going to just kind of be smooth sailing from this point through the rest of the year or even the foreseeable future. So yeah, I mean, I'm a practicing advisor myself, and I've seen a lot of demand for this type of thing. I know clients don't expect guarantees; they just want protection and good risk management. And I've seen these buffer ETFs a good solution for that. So yeah, we've seen the breadth of your offerings expand with recent launches like BFRZ and BALT, QBF and SFLR. So how does Innovators approach bringing a new strategy to the market?
Well, Ken, we always try to take the approach of solving problems advisors are having. And if we go back to the genesis of Innovator, our goal was to disrupt the structured product and annuity industries. We saw the payoffs that those offered, the known levels of risk management. But we also knew that advisors maybe didn't prefer the structured note and annuity wrappers. They tend to be more expensive. There's lockup, there's hidden fees or surrender charges. There's maybe some tax inefficiencies. And so by placing those payoffs in the ETF wrapper, we solved a number of issues for advisors. They can scale these ETFs across their book. They're liquid, they're tax efficient, a huge value to advisors and their end clients. Where if you hold these products for a year and a day, it's long-term cap gains tax treatment, and you can defer those taxes indefinitely. And so I think from our perspective, being able to provide better risk management tools to advisors was solving a huge need, as there wasn't anything like that in the ETF market. And what we found is a lot of advisors were using factor-based strategies or bonds to protect on the downside. And those strategies, they work until they don't. And that's just not a great risk management strategy. And so in 2022 in particular, we really saw the value of buffer ETFs because they provided that known level of protection when both equities and bonds were down double digits. But if we think to solving these problems, so that's when we brought the world's first buffer and defined outcome ETFs to market. But as we kind of grew our presence, something like Bolt was built really based off of our conversations with advisors, and that was built in early 2021. We launched it in the middle of 2021, but our conversations with advisors were concentrated around this problem with bonds. At the time, the Fed had taken rates all the way to zero. And a lot of advisors were coming to saying, look, there is no upside left in bonds. Why am I owning a core bond that has a 7-year duration with maybe 1% yield? They said, look, we're looking to move a portion of our fixed income assets away from bonds, but we can't just go unhedged into the equity markets. And so that's where we saw buffer ETFs become an alternative for them. It's not an equity, it's not a fixed income, it's not a bond instrument, but it's something in between that. And Balt was built specifically for those advisors, a 20% buffer every 3 months. And we try to call that a bond alternative ETF. So the ticker BALT was for bond alternative. We couldn't get it in the name of the ETF. The SEC wouldn't let us do that, but we were able to get it in the ticker. And that strategy has become our largest, right around 1.5 billion in AUM, and it has delivered exactly as it said it would. Since its inception, it's delivered a 5.6% annualized return versus core bonds at minus 1.3%. And it's done so with 40 to 50% less volatility than the S&P, than core bonds, which for advisors that continue to worry about bonds. I mean, the Fed started cutting last year. Why aren't the 10-year yields? Why aren't they down more? Why is the 30-year yield at levels we haven't seen since 2007, 2008? All of that uncertainty that Kent, you are highlighting, that look, we can only rely on uncertainty. That's the only given right now. The bond market is an area where so many advisors have gone to that space for risk management, but right now that is not the place to be for risk management. So Balt is I think a great example of how we take this problem solution approach with advisors. We are in constant communication with advisors. And then maybe the two other examples that I would point out to is our 100 buffer ETFs that we launched a few years ago, and BFRZ. And our 100% buffer ETFs were built to help advisors get client cash off the sidelines. A pretty staggering stat that we lead with today is in the last year, for every dollar that's going into investments, almost 80 cents on that dollar is going into really money market funds first and foremost, or short-term bond funds. And we know that this is often happening at the bottom of the market. And so how do you get that client cash off the sidelines, or how do you avoid going into a money market fund? And that's where the 100% buffer ETFs were built in, because we know when advisors go to cash, their clients, they want certainty. They don't care if their deposits are paying them 1 basis point, because during the regional banking crisis, we saw advisors and clients move from those regional banks to where? JP Morgan Chase. They don't need the cash, but they pay a basis point, but the clients want certainty. Now, the 100 buffers, they give you that certainty, and they give you some equity upside. And so that's where we find a lot of value of helping provide a solution to advisors to these problems like cash, and then BFRZ is that next step out of cash, short-term bond funds.
Yeah. I see, as an advisor, I'm hearing a couple of things out of that, and that's, I like the alternative to annuities and bond funds. So it's kind of like buffer ETFs may not necessarily replace those things, but they're a really great thing to have in the toolkit. And we only have about a minute left, believe it or not, because I'm listening to this and just taking all these notes and wanting to hear more. But we talked about investors and clients. I mean, what category of investors do you see as a primary target for these funds? Like are buffer ETFs catered toward extremely risk-averse investors, or are you targeting more institutional or retail?
It's really spreading across all those segments. We see some retail. We spend the majority of our time. We work with financial advisors, and so that's where we've seen the most adoption of these for the buffer solutions. But we're also seeing it in the institutional community, where we've had some institutions allocating these buffer ETFs that are replacing hedge funds, strategies that they don't really know what they're getting. They're expensive, they're illiquid, and they're using the buffer ETFs. And so really we're seeing the use cases in a variety of manners for risk-averse investors, but even for investors that are maybe a little more aggressive investors, but they need a portion in, maybe if it's 10% of their allocation, they want to be defensive. They'd rather use buffers than say bonds or something else. And it's because buffers are tax efficient. I think that is something that we hammer with wealthy clients. They don't want to pay taxes. Buffer ETFs are tax deferred. Do wealthy investors need the income from bonds? Probably not. A lot of times they're just owning that for safety, but they're also incurring a taxable event. So we're really seeing it spread in a variety of ways.
Okay, well, this is all really valuable information, and as an investment advisor and an investor and a writer on this topic in the ETF space, love to hear more. So maybe we can have you back sometime. But for now, I want to thank you again, Graham Day, Chief Investment Officer of Innovator ETFs. Thank you for joining our podcast.
Thanks so much for having me on, Ken. Appreciate it.
Great interview, Kent. I can see how you two could just keep talking about this topic on and on. So what are some of the ways that you're adopting buffer ETFs in your practice and portfolio?
You're right. I could have kept talking about him or with him for a long time, especially before the interview started. I found out he's from Minnesota, so I had to talk about the Vikings and all that. But anyway, all right, I'm digressing. But yeah. Tell you the truth, I have not implemented them as an investor or an advisor, but I also, telling the truth, he piqued my interest more because I liked what he said about how buffer ETFs aren't necessarily, a one and done investment or a core holding per se. But he mentioned that they can be alternatives to bonds or annuities. So the current environment, which is volatile, okay, for clients or investors who want to protect the downside, but still capture some of the upside. These are somewhat risk-averse investors who are looking for alternatives rather than just the traditional diversification. They're looking for maybe a way to capture the upside. And so instead of diversifying into different assets like, say, bonds and gold and such, and then he mentioned annuities, those are, at least with the fixed annuities, they're guaranteed and you earn low interest. Why not take a chance, a little bit more risk, and try to get some gain out of it at the same time protecting your downside. They worked very well in the first quarter, especially, or actually more into the second quarter. That April dip that we're talking about, the 20% correction, worked very well there. Now it came back up, so it could now arguably could be a time to get back into buffer ETFs if you expect the rest of the year to be poor. So in other words, it's an investment for somewhat risk-averse investors who believe that the future is not so bright, that we're going to see more volatility or downside, and they want to do a little bit better than, say, bonds or the guarantee of an annuity. But that's what I captured from our conversation.
Well, it was terrific. And we want to thank Graham Day of Innovator ETFs for joining us this week. And I want to thank all of you out there for joining us and listening to our podcast this week, streaming or downloading the Exchange Traded Fridays podcast. Remember, if you haven't already, please like, subscribe, or follow us wherever you get your podcasts. And if you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter, where our handle is @ETFCOM. See you next Friday.